Hey everyone, and welcome. Have you ever looked at a company's financial report and just wondered, can I actually trust these numbers? Whether it's the corner store or a massive global company, how do we know they're not just making it all up? Well, it all comes down to a shared language, a kind of rule book that every business has to follow. Let's dive in and break down what that language is and why it's so incredibly important.
So that's the big question, right? How can we trust the numbers we see? If you're an investor, an owner, or even just a curious customer, what's stopping a company from, cooking the books to look better than they are? The answer is a universal rule book, financial accounting principles.
Okay, so here's our game plan for today. First, we're going to talk about what this shared language really is. Then, we'll get into the nitty-gritty questions. When do you actually count the money, and how do you count it? From there, we'll look at the rules for reporting everything fairly, and then we'll tie it all together with the most important part, why any of this really matters.
I want you to think about these principles not as some boring, dusty old rules, but more like the grammar of business. Grammar provides the structure that lets us all understand each other when we speak. Well, these principles do the exact same thing for finance, making sure everyone is telling a financial story that's consistent, comparable, and truthful.
All right, so one of the most critical parts of this financial grammar is all about timing. It seems simple, but it's a huge deal. When do you actually record a sale or an expense? The answer to that question basically decides which chapter of a company's financial story an event belongs to.
So to keep things from getting totally chaotic, all business activity is chopped up into neat little periods, usually a month, a quarter, or a year. Now, to get a real, honest picture of how the company did in that specific time frame, we use a powerful idea called the matching principle. It's pretty simple. You have to match the money you earned with all the costs it took to earn it, and you have to do it in the exact same time frame.
Let's put a finer point on that. The matching principle is all about cause and effect. It answers a really basic question. How much did it really cost us to make this money? By linking the effort, that's the expense, directly to the reward, the revenue, you get a much clearer and more honest picture of how profitable a company truly is.
Now, this idea plays out in two main ways. On one hand, you've got the cash basis. This is super simple. Money comes in, you count it. Money goes out, you count it. It's great for freelancers or your own personal budget. But most companies use what's called the accrual basis. This is where you record revenue when you've earned it, even if the cash hasn't hit your bank account yet. It lines up perfectly with the matching principle, and it gives you a way more accurate snapshot of a company's real financial health.
Okay, so we've got the when sorted out. But that brings us to the next logical question, doesn't it? How exactly do we count? I mean, what dollar value do we put on the things a company owns, like its buildings, equipment, or vehicles?
And the rulebook has a very clear answer for this one. It's called the historical cost principle. It's incredibly straightforward. You record an asset at the price you originally paid for it. That's it. Not what it might be worth today, not what you think you could sell it for, but what you actually paid. This keeps everything objective and based on verifiable facts.
Let's make this concrete. Forget the jargon for a second. Imagine a company buys this beautiful car from overseas to use for its business. Now, the price on the sticker, that's not the whole story. Not even close.
See, the historical cost includes all the expenses that were necessary to get that asset ready for use. So, we start with the purchase price, $10,000. Then we have to add the customs fees to actually import it. That's another $5,000. And finally, we tack on the $3,000 it costs to ship it all the way from the factory.
So you add it all up, and the total historical cost that gets recorded on the books is $18,000. That's the objective, verifiable number. It doesn't matter one bit if the car's market value goes up or down a week later, 18,000 is the number that sticks. It's all about sticking to the facts.
We have covered when to count and how to count. So now let's talk about how to report everything in a way that's fair and honest. And this is where two words become absolutely crucial: transparency and consistency. First up is the full disclosure principle. You can think of this as the no secrets rule. A company can't just cherry-pick the good news to share. It has to disclose anything that could reasonably influence an investor's decision, things like a major lawsuit or a huge product recall. You can't just bury the bad news in the fine print.
Next, we've got what I like to call the play it safe rule, the conservatism principle. It works like this. If you think a loss is coming, you have to record it right away. But if you think a profit is on the horizon, you have to wait until it's a sure thing. This simple rule prevents companies from getting overly optimistic and puffing up their performance based on wishful thinking.
Two other principles are key here. First, materiality.
This is really just common sense. It means you only need to worry about reporting things that are significant enough to actually change someone's mind. For example, a company doesn't need to report a lost box of pens, but it absolutely has to report that a factory burned down. Then there's consistency. This is a huge one. It just means a company has to use the same accounting methods year after year. Without this, you couldn't make fair apples-to-apples comparisons of their financial statements over time.
So we've covered the rules of timing, evaluation, and a fair reporting. But let's take a step back and ask the big question. Why does any of this stuff really matter? What is the real-world impact of all this grammar of business?
You know, at the end of the day, it all boils down to one simple word: trust. These principles create a universal system that allows us to compare companies and rely on their numbers. When you read a financial statement that follows these rules, you can be pretty confident you're getting a story that's consistent and complete. And that trust, well, it's the very foundation of our modern economy. It's what makes investing and lending even possible.
So these principles are what build that foundation of trust, allowing all of us to make smart, informed decisions. But it does raise a pretty critical question, doesn't it? What happens when these rules are bent, or even completely shattered?